Office space borrowers are outperforming the broader commercial market on delinquency, running at less than half the rate of other industries. So why does this sector feel so risky right now? Welcome to the Commercial Pulse update for May 5th, 2026. The Experian Commercial Pulse is a bi-weekly report offering a snapshot of the US economy and its impact on small businesses. If you end up liking this video, remember to hit subscribe to continue seeing Experian updates like this in your feed. Real GDP grew at an annual rate of 2% in the first quarter of 2026, rebounding from the Q4 record-long government shutdown that stalled spending. The data continues to point to a market that is stable but constrained. At the same time, the labor market remains resilient. March unemployment came in at 4.3%, with wage growth continuing, though at a moderate pace. Inflation, however, is proving more persistent. March inflation rose to 3.3%, with notable pressure coming from energy prices, which have surged due to ongoing geopolitical tensions. And perhaps most notably, consumer sentiment dropped to 49.8 in April, reaching a historic low, reflecting growing concerns around inflation and the cost of living. We're also seeing softness in small business optimism, which declined to 95.8 in March, indicating caution among business owners as they navigate these cross currents. Now, turning to this week's featured insight, the commercial office space sector. This sector has undergone a fundamental transformation over the past several years, largely driven by the rise in remote work. To put it into perspective, remote workers represented just 6.5% of the workforce in 2019, and that figure surged to 35% during the pandemic and has since stabilized to around 22%. The impact on office space has been significant. Vacancy rates climbed from 11.4% pre-pandemic to a peak in 2025, and while they've begun to level off, they remain elevated. But here's where it gets interesting. Despite higher vacancy rates, rental prices have continued to rise, now exceeding $38 per square foot on average. And this is being driven by strong demand in major metro areas like Manhattan and Miami, where vacancy rates remain below 15% and pricing significantly outpaces the national average. From a credit perspective, businesses operating in this sector are also evolving. Historically, office space businesses sought commercial credit at higher rates than other industries, but that gap has narrowed considerably. In fact, by early 2026, these businesses are now seeking credit at slightly lower rates than their peers. We're also seeing a shift in the credit mix. While commercial cards are the most prevalent product used across all industries, the office space sector relies more heavily on term loans and lines of credit, while maintaining lower exposure to commercial cards. Conversely, other industries appear to rely much more on commercial cards. And more importantly, this segment demonstrates a stronger risk profile. Late-stage delinquency rates for office space businesses runs at approximately 0.27% versus 0.7% for other industries. And with slightly higher average commercial credit scores, which signals disciplined credit management. So what does this all mean? While structured challenges like elevated vacancy rates remain, the sector shows clear signs of financial resilience, supported by pricing power in key markets and strong credit performance. Looking ahead, there are a few factors to watch. First, whether sustained remote work trends continue to pressure occupancy levels and cash flows. Second, how rising energy costs and inflationary pressures impact both operating expenses and tenant demand. And third, whether disciplined borrowing behavior can continue to offset broader economic headwinds. And there's a lot more on the commercial office space sector in this week's report, so be sure to subscribe. To learn more, visit our Commercial Insights Hub for deeper analysis on small business trends, or reach out to your Experian account team to start a conversation. If you found this update valuable, be sure to like and share this video and subscribe to our YouTube channel for more data-driven perspectives on small businesses. And last, remember to keep informed to stay ahead, and we'll catch you on the next one.